Hi, this is the continuation of the previous video. We are learning how to generalize the transactions. Let's jump on to transaction 7. Rent paid for office premises, rupees 20. Let's identify the two accounts involved. So rent is one obvious option, and then there is office premises, that is the other option, and then you've paid the rent. So I'm going to use bank account because we've agreed that all transactions are going to be bank based. So and possibly maybe you pay this to, let's say, landlord. I'm just improvising, maybe you're thinking about this as well. So landlord's account. So which two are the accounts which we should use? So rent is the name of the expense, and as we discussed earlier, the rent account represents our claim on the use of the office premises. Okay, so rent is clearly one account which we should record this transaction into. The other accounts are office premises. Now, office premises account sounds like, if you create a record for office premises account, it would seem like you own the office premises. But you don't. You only have a right to use it temporarily based upon the rent you paid. So the rent account, has inherent in itself the message that the rent is being paid for office premises. At best, you could say rent for office premises account. You could do that as well. So I do not want to create a new office premises account because that will be misleading. Then you have bank account. Rent is being paid to the landlord or not. So it says rent paid. Rent has been paid. It must have gone through the bank account of the company to the bank account of the landlord. So bank account is involved certainly. Since we've identified two accounts, clearly the landlord's account is irrelevant now. However, I will still justify it why this account is not a viable option. Landlord's account, if you create an account for landlord, that would mean you need to pay, you owe to the landlord. Well, you do not owe to the landlord because you have actually paid it. You will owe to the landlord again next month, but that hasn't happened yet. So landlord's account will not be created. Otherwise, if you create it, that will give an impression that there is a liability, but there is none. You just paid this liability already. All right, so rent and bank account. Rent is an expense and bank is an asset. That's easy. Expense is a nominal account. Asset is a real account. Nominal account, since this is an expense, the rule is debit all expenses. And for real account, bank, it goes out. Bank balance is going out. It is going down. So credit what goes out. So the journal entry is rent account debit and bank account credit 20 and 20. There you go. That's how you write a journal entry for rent which is being paid. Let's go to another entry where you are purchasing building. Purchase building for business use 100. What are the various accounts involved? You have purchase account. You could argue that there could be a building account, and there is money being paid, so clearly bank account. So we agree that bank payment will be made, so bank account is involved. The remaining two options are purchase account and building account. We agreed earlier that purchase account is reserved for purchase of goods which are for resale purposes. You are not doing a real estate business here, although I did not clarify that, but we said we generally are writing these transactions for a manufacturing or a trading business. So you do not purchase goods. Building is not the goods for you. Therefore, you're left with building, and building is an asset. You could also create an asset account. Asset account. Why didn't you do that? Because you have the specific name of the asset. Whenever you have that, you do not create a generic account, you create a specific account. Name of the asset is building, so we don't want to create a generic account. Another possible option could be you purchased building from, let's say, a vendor, a builder, a builder. So you can then propose, can there be a builder account? Well, again, I'll say no, because you paid to the builder. You purchased building. Okay, the transaction does not say you paid, but I'm going to say amount paid. Amount paid. All right. Typically, when nothing is mentioned, you assume that amount has been it's on credit, but when it says that it has been paid in cash, you take it in cash. So I'll try to clarify whatever the case going forward in the transactions. So we are assuming that amount has been paid, so no account for builder. If the amount was not paid, yes, we could create a builder's account, which will be a liability account. Okay, the two accounts involved are building account and the bank account. Building is an asset. All assets are real account. Bank is also an asset and real account. The rule is debit what comes in, credit what goes out. And I'm not going to write the rule in this slide, and I'm gradually going to reduce the steps as well. So building is coming in, bank balance going out. So the journal entry is building account debit and bank account credit. You write the amounts and you're done. That's how you write a journal entry for purchase of a building or any other asset for that matter. Next transaction is about the sale of the building. You purchase the building and now you're selling part of a building. So there could be a sales account, there could be a building account, and you sold the building. Again, let me clarify, for cash to let's say PQR Limited. You sold it to PQR Limited. Okay. So sale account, building account, possibly cash, but we've agreed on bank. So I'm going to write bank account. All cash transactions go through bank, and there could possibly be PQR account. Okay, these are all possibilities. Now, sales is reserved for goods. We are not in the business of buying and selling buildings, so we will not record this in the sales account first of all. Second is building. Clearly, building, when it was bought in the previous transaction, you see, building came in. Now building is going out. So we should record this in the building account. So building account clearly is the correct option. Then you have bank account and PQR. Well, I clarified that this is a cash transaction. When it's a cash transaction, you do not create a record for PQR because he has already paid you. If you create an account that we've sold building to him, then you will be writing, how somebody in accounting domain would read it is that PQR has to pay you, but he doesn't. They have already paid to you. Therefore, don't create PQR account, only create bank account. There you go. So building and bank, again, both are real account. Debit what comes in, credit what goes out. I'm cutting the two steps here, going directly to the journal entry. And the way I write it is debit what comes in. So what comes in is the bank balance because you are selling the building. Bank account debit 30, and building, the asset goes out. Credit what goes out 30. And done. That's how you write a journal entry for sale of a building or any other asset. Let's go to transaction number 10. Received interest income on investment and the amount is missing. Let me say INR 10. So you're receiving interest income. First of all, there is interest. The other account is income, and there is investment, and this money would come into our bank account. We agreed on all transactions through bank. Okay, and then you could say this is being received from bank. So there should be a bank account as well. bank account. This is actually SBI Bank, SBI Bank's account, and this is your bank account in the bank, SBI, possibly. Okay. So, interest income. So, the first option is interest account. Should you have interest account or should you have an income account? We said whenever you have the name of a specific item, you should use the name. The name of the income is interest. So, it's better that we create an interest account, and you could say interest income account because there could be an interest expenses account as well. The two are different things. So maybe I'll just strike it off and I will say interest income account. It gives me, all the things at the same place. The next option is investment. Now, investment is something different. What happens is the business is going to deposit money in the bank. Okay, both are same. Let me see. This is bank. This is business. So business deposits 100. So this is an investment. We do an FD. And then bank returns the interest. Interest is being paid. These two are separate transactions. Do not mix the two. When investment happens, then you consider it as an investment, and investment is an asset. So that is considered, when the investment happens. At this time, in this transaction, what is happening is you are receiving interest, and this is an income. This is a separate entry, a separate transaction. So do not worry about investment. You are receiving interest due to investment, that is fine, but there is no transaction happening about the investment. So there you go. You have bank account and interest income account. Okay, let me now clarify the interest income account. This is an income clearly and hence the nominal account. The other one is bank, which we have done so many times, the real account. Okay, let me skip the rules and directly write the journal entry. Bank is coming in, real account, debit what comes in. Bank balance is coming in because you're receiving this money. So bank account is debit, and on the other hand, you have nominal account, which is debit all expenses and losses and credit all incomes and gains. This is an income. So credit all incomes. Interest income account credit. And let's say 10 is the amount. And you're done. That's how you write an entry for interest income or any other type of income as well. Next up is depreciation on building. I think we briefly touched upon depreciation before. I'll again clarify it. You have an asset, you purchase an asset, its value is 100. You use it for a year. When you use it for a year, its value goes down because there is wear and tear, there is reduction in the efficiency of the asset and so on. So when you reduce the value by a certain rate, the reduction is called depreciation. And then you have a new book value. So this is the depreciation that we're talking about. And depreciation of building charge. The word charged means this process. At the end of every year, you have to charge depreciation. So when you charge depreciation, you don't pay this money to anybody. You're just reducing the value of the asset. Now, why do you do that? Because of matching principle. The matching principle says the revenues of current year should be matched with the expenses of the current year. Now, the allowable expenses, the expenses which are allowed to be included for this purpose, also includes the use of asset for that 1 year. If you remember, asset builds long-term capacity for you, but long-term essentially is sum of short terms. So a long-term asset contributes to revenue generation a little by little every year. So in the first year, if you purchase this asset, in the first year, this asset contributed 10. So 10 rupees is an expense for the first year, and then 10 rupees for the next year, and so on. So the value of the asset, a part of value of the asset, is converted into an expense every year. So for now, only that much is sufficient. As we move forward, we will talk more about depreciation. So the two accounts involved, what are these two accounts involved? So depreciation, then there is this building, and since there is an amount mentioned, let me just write bank account here and then I'll negate it, of course. I mentioned that there is no cash being received or paid, so bank does not get affected. The only thing which is happening is value of building is going down, and depreciation is a new expense, non-cash expense. You're not paying it to anybody, but you are allowed to show it as an expense during the calculation of profit. So the two accounts involved, depreciation being an expense is a nominal account, and building being an asset is a real account. Again, I'm skipping the rules to be quicker through this, and you should try to do it this way as well. So what is happening is depreciation, a new expense, debit all expenses and losses. So depreciation account debit, and building an asset, debit what comes in, credit what goes out. Building is going out in the way that its value is reducing. You have used part of the asset in this year to generate the revenue, so that asset is not coming back. That value of asset is now gone towards revenue generation. So we're going to write building goes out, building account credit, and the amount is there. That's how you record depreciation for any asset on which depreciation can be charged. Okay, let me go to the next transaction, which is received cash against credit sales 40 to PQR. If you remember, in one of the earlier transactions, you had sold goods on credit to PQR. Now you are recovering that money. So let's see which accounts are involved. So cash account is involved, or let me say bank account is involved. Then there is sales, so sales account, and now there is PQR account. All right, let me do the identification of correct accounts. The money has been received, bank account is involved. Okay. Sales account. Right now, there is no sale which is happening, only collection is happening. Sale happened earlier. When sale happened, you wrote it in the sale account. At this point in time, no sale is happening, only money is being received. So you do not write anything in the sale account. But PQR is the one who is paying you this money back. So you should certainly write in the account of PQR. So PQR account is the other account. So two accounts involved are bank account and PQR account. Bank being real account, and PQR being your customer. He was your debtor, and we said all debtors, assets should be treated as real account as well. So this is a debtor, hence an asset, hence should be treated as a real account. Okay. Debit what comes in, credit what goes out. He's paying you the money, so bank account coming in, bank balance coming in, so bank account debit, and the PQR who was an asset to you earlier is no longer an asset to you because he has paid. So that asset is going out. You're converting one asset into the other asset. So I'm going to write PQR account credit 40 and 40. There you go. That's how you write the transaction for receiving the cash from a customer. Only two transactions left. PQR went insolvent. What is insolvent? Insolvent means you're not able to meet your expenses, your liabilities, and you are closing down. When that happens, you cannot recover the amount from that customer. So PQR was your customer. Now he cannot pay you. So how much was remaining? So if you see 40 has been recovered, so let me say received is 40. How much was the sale? That is the question. So I'm going to go back and I'm going to look for the sale here. You sold goods on credit, transaction 6, 50 rupees worth of goods were sold to this person here. So 50 rupees of sales was made and this is the balance. 10 rupees has to be recovered from this PQR. Now he is not paying you, and when that happens, you have a loss. You have to recognize a loss. So the name of this loss. So you have to recognize a loss. The name of the loss is called bad debts. Bad debts. Understand that PQR is your debtor. Is your debtor. When he cannot pay to you, he becomes a bad debtors. And the collective term for all these debtors who can't pay you now is bad debts. It's a loss. So that's the first account which is involved. The other account involved, of course, is the PQR. So PQR is the other account involved because he can't pay you, so you have to adjust his account. So in this is a typical transaction, exceptional transaction where you have to use more logic than the scientific method that we've learned here. So in the previous transactions, what happened was you first sold goods to PQR. When you sold the goods to PQR in the first step, the journal entry was PQR debit and sales credit. So 50. This was the first journal entry. Then PQR paid you. You wrote a journal entry, bank debit and PQR credit and 40. Okay. So this was transaction 4 and this is transaction 12, I guess, the previous transaction, right? So refer to transaction 4 and this is transaction 12. Now, if you look carefully at these journal entries, PQR, an asset to you, a debtor, it was valued 40. Debit, increase in the claims of the business on PQR. And then PQR paid to you 40, so given a credit, so businesses claim on PQR go down. So 40 was credit. Now the net effect is that there is still a 10 to be recovered from the PQR. So the 10 to be recovered in the PQR has to be cancelled out. In order to cancel it out, you need to do another credit of remaining 10. So I'm going to write PQR account credit by 10, and this is happening because there is a loss, and all losses are so bad debts account debit 10. All losses are debit. So debit all expenses and losses. That is what we are following for the bad debts. And PQR is being credited because there was a balance in PQR account and you have to cancel it. You have to give additional 10 rupees worth of credit because he's not going to pay you. You can't anymore show this person as a debtor in the books of account. So all debits have equal credits. You can in the same account, PQR's account, if you do another credit, debits cancel the credits in that sense. So you give a credit, that means debits are equal to credit, nothing to be recovered from the PQR anymore because it's been declared that he can't pay anymore. Okay, let's go to the final transaction, which is you pay for credit purchases to ABC Limited. You also did a credit purchase and you're going to pay for it. So when you pay for it, you have the following possible account options: purchase account, you have ABC account, and you have a bank account. Okay, which accounts are involved? Well, clearly you are paying for the purchases, you are not doing the purchases, so I'm going to cross the purchase account. You are paying through bank and you are going to pay to ABC, and ABC is your creditor. Alright, so ABC being your creditor is a liability and hence is a personal account. Is a personal account, and as we know, bank is a real account. Okay. Now ABC is a personal account. The rule is debit the receiver. The business is paying to ABC the money. ABC is the receiver. So debit ABC's account. ABC Limited account debit, and bank is an asset, and credit what goes out. The bank balance is going out. It is reducing. So bank account credit 50 and 50. So there you go. We have learned how to journalize the transactions in the book of first entry called journal. We took a step-by-step approach in which we identify the accounts in which the entry should be made. We identify the nature of these accounts, personal, real, nominal, and then we use the rule of debit and credit for personal, real, and nominal accounts, and then we write the journal entry. Once you get more versed with it, you don't have to go through these steps. You can just look at the transaction and write the journal entry. That's how it happens. So let's go to the next section, which is the output of generalizing. So I told you that you don't have to go through this step in the actual book, the journal. The way the journal entries appear are as follows. Here. So in the date column, you can write date. In this example, we did not have date but transaction numbers. So I've just written transaction 1, 2, 3, 4, and so on. You have the in the particulars column, you write the journal entry. You have bank account debit, and you have owner's capital account credit. Now, this is another convention that is followed. The account which is credited, you write a 2 in front of that, and you press a tab here in computer language. So you write bank account debit to owner's capital. But if you write owner's capital account and credit, that's also fine. Does not matter as long as you understand what these things mean. Then there is a short description of the transaction, that the capital brought in by the owners of the business, just for reference sake. And there is a debit amount column. So against the debit account, you write the amount. Against the credit, you write the amount. And you will notice that all debits will have equal credit. 100 and 100, 200, 200, 50, 50, and so on. So this is how a journal is going to look like. Transaction 2, you have debit account, debit, credit. Don't be worried about this. I just showed this because in different textbooks you have different formats. This is conventions that are followed. So you could deviate from it as well. So bank account debit, owner's capital account credit. That's a way to go. Easier way to learn as well. But 2 is also fine. I'll mix these two conventions in the future session that we have. So, all these 14 transactions have been listed. This is how they are going to be finally presented. Now, understand that, all this process is automated. There are softwares which do all of this. My intention of walking you through these rules and through these, through the process of writing the entry is that when you look at the balance sheet or income statement, when you have to sign off on any of these statements for your company, you should know how these numbers are arrived at. In my experience, I have seen accountants making mistakes. I have seen chartered accountants also making mistakes somewhere, and it's handy to know your stuff about generalizing, about recording the transactions, so that just for the betterment of everybody, for the security of everybody, if you know these terms, you can identify those mistakes wherever they are. Alright, let me stop here. I'll see you in the next video, wherein we will look at more journal entries, in more faster and quicker manner, not necessarily going through baby steps, but arriving at the journal entry first, and more complicated transactions are also going to be taken up. I'll see you in the next video.